Okay, I made a couple of videos about carrying charges and details, and I decided they're just too boring. They're too boring to even post. I thought they're interesting. I thought they're important, but I doubt anybody really else does. So I'm going to show you a summary of the carrying charges on this one. And I have watched videos on Power BI, and I noticed that people make much better videos than me, first of all. And then I also saw, oh man, this is cool. I didn't say it really like that, but kind of, because really I'm a lot older than saying stuff like that. Okay, and then so we can draw these maps and all that stuff, and then we can click on this, and if we this has got solar power, and this is for ground mounted, what the cost of capacity is, and China is way down here, Japan is way down here, US is way up here. So what? China is 937 and US is there. And there are all sorts of things I'm getting slow at. I want to put the labels on. It's, I'm sure, very easy. I didn't get that yet. And then you can go to the thing here, and instead of putting the overnight cost, maybe I could put the capacity factor. So that's all very nice. And I'm going to do this so slowly because I am stupid and I can't seem to get it right. And when I looked at those videos, it seemed so ridiculously easy. And what I'm going to do is take it straight from this thing called the IEA, and this report that they do every 5 years, which is really cool. Now it's free. You used to, I think, right when it comes out, you have to pay for it or something. But here, look at this. The numbers aren't. They've got spaces. So we're going to go kind of crazy with the read PDF to show you how to read some of these things in, and eventually we're going to compare natural gas to coal to nuclear, of course, which they say has a very low cost because of the way they do the carrying charge rates, to solar. And we're going to look at what the solar overnight cost is. And we're also going to look at our battery database, and I'm going to try to get our battery database into the Power BI. Okay. Now, when I do that, it's not. There's a whole lot of stuff you have to do to get it into Power BI. So we want to show you how to take this thing to Excel, fix it, clean it, excuse me, and get it into Power BI. But before that, I really do have to summarize the most important thing of all, which is getting the carrying charge rates right. Because levelized costs are a function of the capital cost, the fuel cost, the capacity factor. All those are easy. Carrying charges depend on what kind of timing assumption you make, what kind of inflation rate you make, what kind of equity return you have, and debt return, and credit spread, what's your construction period, how you spend your construction, what's your operating period, how you're going to have decommissioning and replacement, what your taxes are going to be. All of those things have an effect on the carrying charge, and we want to boil it down to one number. And in the past, in my classes as well, I think I've made it seem simpler than it really is. Now, in order to do that, there are going to be the standard principles we have, and I'm going to go through this really fast. The principles are going to be the getting a timeline right, putting the assumptions in a logical order, starting with the construction, doing it in nominal and real terms, getting all of the replacement costs and depreciation in, and finally getting the payment resolved. And then this is our final carrying, and then doing a financial statement analysis where we go all the way down to a profit and loss statement, IRRs, and all the same kind of things. It's all project finance, really, or corporate finance, kind of both. Now, I have to show you some gimmicks, as I always do, and there's a pizza just coming to the door, so I got to... That pizza was not mine. Stupid. Okay, now, I press Shift-Alt-C with the generic macros open. This is kind of the opposite of Power BI. You have to do things yourself. You have to learn a little bit of VBA. You have to learn a little bit of programming. There is no hidden things here. You can get this, figure it out, and do it yourself. So we can change the, you know, the color inputs. Okay, I'm just going to show you our color inputs. We can change the title inputs. How about, let's make this solar, so maybe I'll make it green. You can remove links, you can delete blank rows and columns now, and then you just press color the sheet. Takes sometimes a minute or so because it's got to go through every row and every column and look across to the other sheets. Okay, so we colored everything. It put a conditional formatting in for the true and false, and it colored the inputs, the input assumptions we have. And if I wanted to color the direct links, okay, the places where, for example, down here in all of our efforts to make it transparent, we just put equal G46. Maybe I want to make that red. Then we would press Shift, Control Alt C again, and you would add the links to the current sheet, and then you'd have to recolor it. Okay, now I put little stupid things like this in spinner boxes just because when I was creating this sheet, I was working on it. Now, this sheet is a standalone sheet, so I can copy it, and we can copy it 10 times and make different assumptions for different kind of, if we have the battery costs, for example. Here's the thing I get so worried about batteries. Just like in your car battery, it goes out after you use it for a while, just like your iPhone, your LG battery. Oh no, this kid is yelling. If we have a longer life, the battery life, they're supposed to get longer now, but eventually they're not that long. And then these ones with the long life, these are lead, let's put this lithium ion battery, I think. Okay. And I should be using the lowercase, of course, for the excuse me. These are all the chemicals you could use, I suppose, in batteries, but to retain the charge, and have the positive and negative charges and all that stuff. Here, the cost per kW. This one we have a life of 10 years. The cost is this. Let's find one with, excuse me, I'm wasting time. Oh no. Here, let's find it with a cost with 20 years. Then we might have a replacement cost, and this I should be looking at the cost per kilowatt hour. And that replacement cost is not nearly as high as the original cost, but there's a big replacement cost. So now let's just go through some of this. So let's put a battery life. This is the problem. I'm going to make a construction period here. Let's start with the beginning. Excuse me for this. Let's say we have an inflation rate of about 2%, which we have these days. Let's say you want an equity return of 8%, which is high, I think, but whatever. No, I can't. Let's make it 7%. Let's say our risk-free rate. Now, we really have to think about the risk-free rate so carefully. Is this, if you have a swap, that's kind of hedging out some of the risk, but it's also giving you an indication of what the inflation rate is. So I'm going to make a risk-free rate that's actually lower than the rate of inflation, which is a negative real rate, which has happened these days. And then let's make a credit spread of about 1.5%, which is almost better than a triple B. And let's make the debt percent 70%. Okay? Then we should be looking at our carrying charge each one. If I make the debt percent 0, then it's 13% of the cost that we have to recover each year. If I make it 90%, it goes down to 11%. It's not that good. It's not that much difference. If I made this 15%, of course, then it would be an enormous difference. Okay, so we get everything, we just put it in, it's all consistent, and we can see what I'm going to put 90%, oh no I won't, I'll put 80% in, okay? And then we say, okay, what's the construction? Now if we have a longer construction period, you know, it pushes the cost up substantially. And then also, if you have this gives you the mean for the S-curve. So if you put that much later, it goes down. If you put it much earlier, it goes up. And you can put all this standard deviation stuff in. So if I make the standard deviation, let's put it back to 0.5, I can make the standard deviation give you a spread like this. If I make it 1, it kind of flattens it out. 0.5, it makes it really flat. 6, I make it really thin. And I'm not really looking at, I was looking at the input, not looking at what happened to the carrying charge. Now this operating years is enormously important. And that it's enormously important when the cost of capital is low. Look how low if we have 32 years, we have a cost of 5%. If we're putting to 10%, 10 years, we have a much, much higher cost, of course. And here is the really big deal. This relationship, and I give you all these sensitivity and scenario analysis, you look on all these ones, but there's a relationship between the cost and the return and the inflation rate. If the inflation rate is 0, we get a higher carrying charge. If we put a 5% inflation rate, we get a much lower one. And then that all gets aggravated when you put a really long-term analysis in. So I put a much longer term analysis, and then let's put 2% inflation, and let's put a 0% cost. So we're from 7% down to 5%. Okay, and if we put an even higher inflation than the risk-free rate, which we shouldn't do, then you get a lower cost, because the carrying charge rate, as I said in an earlier video, is all related to the current cost that gets inflated. Now if I put 0 for this has a replacement cost, so if I put 200 as the replacement cost, of course it's bigger, and then it depends on which year you spend the replacement, and then you can put a 200 as a decommissioning cost, and each time the equity return and the IRR, they're all working. Okay, and then we can put a tax rate. I haven't even put a tax rate in. Now when you put a tax rate in, you also have to think about the tax depreciation. So I put a little spinner box. Let's put 30% in here. And let's put excuse me, 0 as the debt to capital, because it's very closely related to the debt to capital. So if I put 30 versus 0, I get not as dramatic as you might think. Now, if we had I've said apply tax depreciation, I'm going to put false here. Okay, and then if we have, let's put 0 tax rate in. 7, if we put 50% tax rate in, it goes up by about double. It doubles it. But if we get a tax depreciation, that takes away the effect dramatically. If the tax depreciation is really short, it's almost better. This assumes you can use another asset to offset the cost, or you have some sort of scheme to do it. But if it's a 30-year depreciation, which is longer than the asset life, I think, let's put 20. then the tax depreciation has the tax rate has a much bigger impact. And we can put this 1 says, if you put 1, it gives you straight line. 2, it gives you double declining balance. That's this VDB thing. Okay, and then let's just walk through. So step 1 is to compute the normal distribution, and you take this F34, the middle of in this case, it's the middle of the construction period, and then you put in your standard deviation, and you get a normal distribution, and you compute your normal distribution relative to the construction period, and you multiply it by the switch. And if you didn't have those timelines at the top, you'd never do anything, and then you'd normalize it, okay? And then we put an inflation rate. Now, when we put an inflation rate in, we go through and decide if I would put this, and I made the whole thing so we could do it in monthly, in annual periods instead of monthly periods. And this wasn't a big effect. Let's look at if it's month by month, we get 10.2. If it's annual, we get a higher amount. Let's put it back to 80%. That's dramatic. This is the effect of the tax depreciation now, okay? All right, and we have because of the high tax rate, we have actually a declining kind of thing. Let's put a 20% tax rate back here. Okay, and then let's, here I'm making sure our equity IRR and our WACC is still always the same. Okay, now that I showed you the cash flow. Whenever we do this, okay, so after we have the construction defined, then we inflate it. And I was trying to show you, which I didn't do very well, but we just put, depending on our factor, we adjust the inflation rates. So if this is 12, I just use a data validation, then we just get the regular old inflation rate. Otherwise, we take 1 divided by 1 plus the inflation rate raised to the 1/12 power minus minus 1, right? And you have to do that with all of these variables. Okay, and then you put a carrying charge during the construction period. That's like something used to be called AFDC or AFUDC, allowance for funds used during construction. My big subject in the 70s that I worked on. Oh, 80s, sorry, early 80s. Now we put the replacement cost in, and for all the replacement cost, we have to come up with a NPV of the replacement cost, and that NPV we take the way it works is we take that to COD, and you do a little trick where you put a little if statement, and if it's the construction period, then you if it's the construction period, you just leave it on the period right before the construction period. You notice all these periods are the same, and then you increase it after that. And then you do the same thing, take the NPV of the decommissioning. And it looks like I have no decommissioning and no replacement cost, or let's put just about 80 as a replacement cost and 100 as the decommissioning cost. So that increases our carrying charge a little bit because we have to recover those factors now. And then we put in all of the information about a tax policy. Okay, if you want to do this on a pre-tax basis, you could put 0 in. I'm sure that's what for some, true pure economic analysis, it's a flow from the project to the government. So if you're just purely looking at the real cost, you might take that out. That's up to you. Okay, but if you're looking at it from a real private perspective, you'd leave that in. So then we take our present value of our tax shield in the same way, and when we do the present value of the tax shield, we have to take the depreciation on the replacement and the decommissioning. And notice how I put a period in here and said we have to use a roundup for the period and then use the lookup function for the depreciation and divide it by the number of periods. Then we put all our stuff together. We put how much construction we have with the financing, how much replacement and decommissioning have, what's our present value of our tax shield. This is not easy, but I doubt anybody really wants to do this. But people might want a little program, and you can look at this yourself, of course. And then you get the inflation, but you just take the inflation from the COD. And if you don't believe any of this stuff is working, after you've computed this thing with the payment function, which was our very kind of first thing we did. Where is my payment function? Here. This is the payment function. And you do that at a real rate. And once you do it at a real rate, you then escalate it. Okay, and then you put in all your taxes and you get the IRR. Okay, and finally you take that first period, you go to the COD, you use a lookup function, and you find the first period carrying charge amount, you annualize that, and that's our number. And then the rest of this stuff goes through piece by piece by piece. Computing economic depreciation. If you want to get the equity IRR and test the equity IRR, okay, you have to test the equity IRR to make sure everything's really working. Okay, and if you want to do that, you have to compute, and I get obsessed with correct calculation of depreciation and economic depreciation rather than accounting depreciation. Then I was an accountant once. Well, I worked for an accountant. That's going extreme what I just said. We get our deferred taxes, and we get our debt schedule, and we get our financials. You can look through all of this. It took me ages to do. And I'm only doing this really for kind of classes and for videos and all that. And then we can get our DSCR. We can take that whole carrying charge analysis, and the trick to getting the financial statements right is to get the total capital you have, the total capital investment you have, and then just say, well, let's take 80% of that, and that's debt, and let's see how much we're spending, and we borrow 80%, and at the very end, this is just a thing of beauty. This is just a thing of beauty. You get 80 to 20 the whole time. You keep a constant capital structure when you do all of this. I made a whole nother video on it. Maybe I'll post that later on. Okay, but it goes through. Now, what I didn't show you right now is I could not see what happened to when was the COD and when was the replacement cost occurring and all that. Now, what I did is made a little range name called output. And this range name called output just has all of the things. And if you want to make then a conditional formatting, here's what I suggest you do. You make a new rule, and you use a formula for the rule, and you go to the top left, and let's always kind of go to the top, and press the F4 just once at least, or, yes, and let's make that equal to the COD. Now the COD is somewhere else, but up at the top, I tried to clearly, and I think this is what you should do, is you should clearly put the dates in your assumptions, really. And then let's format this, and let's make kind of a moderate color, okay? So we'll make our yellow our COD. And then let's make another one. We've still got it on the thing, and you always have to start at the top left. And you've got to go to the new rule, use a formula, click on the starting date again, and press an equal sign, and this time let's go to the date at which the replacement occurred. Or no, let's go to the decommissioning date. And how about let's make that one some kind of, I wanted to find a light red color or something. I don't know where I could find that. Okay, I'll make it that one. I'll make it a dark one. That's kind of violating our stuff, but we can see exactly when the end is. And then let's make one more thing and go to the conditional formatting, make a new rule, use a formula. Sorry to be so repetitive, and take the starting point, press the F4 key a couple of times and put an equal sign, and this time go down to when you're making the replacement expenditures. And let's make, we made it yellow, and how about we'll make that one a light blue. Okay, and then we can watch it not have worked. But then, here's when we can see our COD happened, and then we go way down because remember this is monthly now, and I think I have a long period. Come on, come on, come on, come on, come on. And we somewhere have a replacement. There's our replacement. And here's the other thing. I used to be one of these people who put all the true falses in one place. Please don't do that anymore. Please put the true falses other than the operating period and the construction period. Put them when you're going to make the computation. Make it transparent. I've been really depressed about not getting any classes at all. I've been really depressed, but I looked at FAST and they're right. They must get a whole bunch more than me. And this business of making it transparent is really good. And part of making it transparent is putting the true falses right where you have them. Okay? I mean, right where you're going to compute them. And there finally is our decommissioning. And if you watched me, there was a tiny little problem with the decommissioning. This has got some kind of replacement cost. This is the cash flow. This is not the payment. This is after you reflect the taxes. So it's a little bit different than, it's a lot different than the pattern of the charge you're going to make to consumers. And now you can really see. So let's put the construction timing back to 12, and then we can then it gives us a clearer thing. So then we have a much faster replacement cost and all that. And we make sure everything works and all these equity IRRs and all that work when we have our different kind of assumptions. And there's one or two things I have to fix still on this, but I'm going to leave this video here and stop it.